In a dramatic turn of events this week, global oil prices dropped 10% in just one trading session, following major developments in the Middle East conflict. The Strait of Hormuz, the world's most critical energy choke point, reportedly opened for commercial shipping according to statements from Iran's foreign minister and President Trump. Iran's foreign minister announced that passage is clear and safe for vessels, while emphasizing the 10-day ceasefire with Israel and Lebanon that started recently. President Trump confirmed the opening of the strait but issued a stern warning that the naval blockade would stay in place until a comprehensive deal is finalized. This news triggered an immediate relief rally across financial markets, with U.S. equity futures surging to fresh highs and Treasury yields tumbling to one-month lows. Hedge funds such as Point72, Jane Global, and Millennium that suffered war-related losses are now reportedly back in the black thanks to the sharp reversal in oil prices. Suffer really in the black. That's the Sea Shark's war-related losses and involved parties remains quite fragile, with significant tail risks still present despite the positive headlines emerging from the region this week. Behind the oil price plunge, a deeper tension is building between short-term market relief and potential long-term structural damage to global energy supplies. Now focusing on the latest twist, Iran's leadership has strongly rebutted President Trump's recent 7 statements regarding the ceasefire negotiations, labeling them all as complete lies. This sharp Iranian rebuttal raises serious questions about the accuracy and truthfulness of information flowing from the White House during these highly sensitive diplomatic moments. Why would President Trump issue several statements about the ceasefire negotiations that Iran has now publicly dismissed as 7 complete lies during this critical period of delicate talks? One possibility is that these comments represent a deliberate smokescreen strategy designed to apply maximum pressure on the Iranian side during the intense bargaining process. Alternatively, some market observers are now questioning whether President Trump or his close associates may have positioned themselves ahead of the positive market reaction to his recent announcements. This speculation gained traction after yesterday's sharp market rally in equities and the subsequent announcement that the SEC has launched investigations into suspicious crude oil trades. These trades are alleged to have profited enormously by betting on a sudden shift in tone regarding the ceasefire just before the public announcements were made. Such developments highlight the complex and this makes virtually every trade in equities, credit rates, or currencies essentially a high-stakes bet on the outcome of fast-moving events unfolding in the Persian Gulf region. Meanwhile, on the diplomatic front, multiple ship owners and traders are adopting a very cautious wait-and-see approach before resuming full tanker traffic through the strategically vital strait, as reported by Bloomberg sources. Financial markets have reacted much faster than the underlying physical reality of oil flows, which could realistically take several weeks or even months to fully normalize across global routes. With this comprehensive picture of the latest geopolitical breakthrough and its controversies now clear, we must examine what the top investment research reports are saying. The interplay between these fast-moving news events and in-depth professional market analysis promises to reveal crucial insights for investors navigating these turbulent times ahead. Yet the JP Morgan strategists warned that financial prices have normalized far faster than actual tanker traffic, which could take weeks or even months to fully resume, according to their detailed commodity analysis. Global inventories sit dangerously low, with OECD crude stocks risking operational minimums by early May if physical supply fails to recover quickly enough right now. This glaring disconnect between market euphoria and physical reality forms the key tension that investors must navigate in the coming trading sessions ahead, folks. Notably, equity and credit implied volatility dropped sharply from peaks, while rates and oil volatility remains stubbornly elevated in the options market right now. Investors appear unconcerned about growth derailing, but deeply worried the conflict has permanently shifted the inflation outlook higher for longer-term impacts. The energy shock has already pushed U.S. core PCE to 3.2% in March, marking the highest reading since early 2024. Meanwhile, Iran labels 7 of President Trump's ceasefire statements as outright lies, exposing potential smoke and mirrors in high-stakes diplomacy games. With the SEC investigating suspicious oil trades profiting before the announcements, questions swirl about who truly benefited from these rapid market swings, folks. Domestically, the report spotlights how the Fed remains boxed in by sticky inflation data and ugly political fights over its own leadership succession now. Kevin Warsh faces confirmation hearings Tuesday amid the Tillis blockade over the Powell probe, creating real institutional uncertainty at the central bank now. Trump has vowed to fire Powell if he tries to stay on as governor after his chair term, raising stakes for Fed independence dramatically here. Even dovish governors like Waller and Moran now signal less enthusiasm for rate cuts, given recent firm price readings across the board completely. This policy paralysis hits at the worst moment for the housing market, where affordability has suddenly deteriorated sharply in recent weeks right now. Existing home sales plunged 3.6% to a 9-month low, while builder confidence fell 4 points to a 7-month low. Higher fuel prices are now feeding directly into building material costs, exacerbating the supply-side pressures in an already tight housing market right now. Consumer sentiment plunged to a record low of 47.6, according to the University of Michigan survey released this week. Next week's retail sales data will paint a misleading picture, with headline gains fueled almost entirely by higher gas station receipts alone now. The critical control group that feeds into GDP calculations is expected to show only 0.1% growth, revealing underlying weakness clearly. Households face a painful crowding out effect, where extra spending on gasoline crowds out purchases of restaurants and other discretionary items completely. Though jobless claims remain low, the labor market lacks strength to cushion an extended energy shock without meaningful economic fallout ahead. JP Morgan stays cautiously bullish, recommending full investment with hedges in quality names while favoring momentum and quality growth stocks overall. Their strategic preference tilts toward quality growth over speculative plays and non-AI cyclicals as the semiconductor upcycle gains fresh momentum now. Yet that semiconductor momentum may soon collide with next week's pivotal event starting Tuesday, when Kevin Warsh testifies before the Senate Banking Committee in Washington, folks. He must square his rate cut advocacy with an inflation backdrop that simply refuses to cooperate, as core PCE hits 3.2% now. Meanwhile, all eyes focus on whether United States-Iran talks resume this weekend in Islamabad, where the 10-day ceasefire offers a narrow diplomatic window now. If these talks produce a framework, in the background, the AI trade keeps strengthening, with TSMC and ASML guidance confirming the semiconductor upcycle is re-accelerating strongly as expected now. Yet do not lose sight of the hypocrisies as Iran brands 7 Trump statements as lies, exposing possible smokescreens in the diplomacy game, folks. And with the SEC now probing suspicious crude trades made before the sudden attitude shift, questions linger about who truly profited from this pivot, folks. Reeks of hypocrisy, where public narratives mask private gains while everyday families suffer surging gas prices and frozen home buying power completely right now. Look at the data. Existing home sales fell 3.6% to 9-month lows as the NAR Affordability Index posted its first decline recently, folks. Builder confidence dropped 4 points to 7-month lows, with fuel costs now hammering the material prices in an already strained construction. Sadly, right now, consumer sentiment hit a record low of 47.6, worse than previous floors, making clear the household pain is very real now, folks. Next week's retail sales will show headline strength driven by gas stations, but the control group crawls at just 0.1%, exposing weakness clearly. This crowding out effect means more money spent on fuel leaves less for restaurants and discretionary spending, hammering the real economy hard right now. Though jobless claims stay low, the labor market cannot absorb prolonged energy shocks without consequences hitting Main Street squarely in the face, folks. JP Morgan sees U.S. GDP solid at 2.3%, but the conflict still disproportionately hurts importers, while America stays relatively insulated now. Yet the Saudi finance minister warns physical supply normalization unlikely before late June, meaning inventories could hit dangerous lows by early May, folks. So the financial rally races ahead, but physical reality lags, creating the perfect setup for another painful reversal down the road completely. Investors hedge stagflation with sticky rates vol, while growth collapse fears fade, revealing the true worry is higher for longer inflation ahead. The ceasefire trade delivered another leg higher, but the gap between optimism and reality remains dangerously wide for all to see now. The Fed stays boxed in by politics and data, leaving households stretched by energy costs and unaffordable housing, with no relief in sight, folks. Behind it all, Xi Jinping positions Beijing as the stable center of a reshuffling order while Washington plays dangerous diplomatic games openly. The market is pricing in resolution, but the real question remains whether the world can actually deliver without more broken promises and market whiplash ahead. We covered the ground this week, folks, and the narrative cracked without breaking, so stay informed because the tail risks have not disappeared yet.